Hello everyone, welcome back to my channel. Today we are discussing the way that retail traders see the charts and how do the big boys and banks see the charts. Uh, so we are trying to find a correct way to read these candles and movements. In an example like this, let's say a retail trader would refer to the previous movements in order to predict the future movement. So he might say, okay, the prices, he will draw these two imaginary lines and he will call them support and resistance. I will tell you how. He will say the prices broke above this certain level here and then they bounced back and moved up again. So he will call this line support. Support means every time the prices come back here, they will bounce back up and they will go to new highs. This is the retail trader way of thinking. And then another support here. We'll say, okay, the prices went up and then they came back to this line. When he will draw this line, when he will see this bounce back and then again to this line and then again go up. So we'll say, okay, this is another support. They might use also things like Fibonacci, like they say, okay, the prices moved from here to here, like let's say $100. So now it corrected $50. So this is the Fibonacci 50%, whatever, and go back. And then he expects the prices to come back here and then again go up. But in reality, it doesn't happen. So again, the technical analysis will say every time a support is broken, it becomes a resistance. So this time, let's say, what did a retail trader do in this scenario? He saw this movement and then maybe he made money here, maybe. But in the next movement, when the prices came back here, he had put a buy order here and his stop loss just here, because he was hoping the prices would touch this support and go up again. It didn't happen. It came below this line, touched it, and went further down. So this time he will say, okay, the support is broken, so this is now a resistance. So next time the price, he's waiting for the prices to go back here and fall again. Here again, he will say, okay, this support is broken, so now it's another resistance, and he will want to sell from here and hope, just hope the prices will go further down. This is the way the retail traders see the market. One of the techniques they use is the support and resistance. It is widely used among the retail traders. Now, in a scenario like this, the banks, the big boys know how you're thinking. So, let's say we are watching the market live now and we are going to decide what to do next. Okay, the retail traders, they will wait for the prices to come to this so-called resistance, and then they see a slight movement down, so they become sellers in the market, and then they put stop loss here and they profit below here. The bank, on the other hand, has different plans. He will want to make you think that the prices are actually going down. The prices do move a little bit down. Might happen in many cases that the prices do a slight movement here. And then he will push the prices up here. All right. So why do the banks behave like this? The bank's plan is probably, if the bank with the billions of dollars is coming into the market, he wants to buy, let's say, thousands of lots here in this level and sell somewhere at least here, if not higher. The banks don't come to the market for a small, tiny piece of the market. They want all this. You would do the same if you had billions of dollars. Even if you have $1,000, you would want to buy, for example, gold at the price of 3,000 and sell it at the price of 3,200. You don't want to buy at the price of 3,000 and sell it at 3,030 or 40 if you think big. The big boys think big. So they will want to buy in this area and then push the prices up here and sell at this price in order to make a huge profit. In order to do that, if you're a bank and you're buying 1,000 lots of gold or whatever thing here, you will need sellers. If you want to buy, you need sellers. So you need enough stupid people to think that because the prices were coming down and because there is a resistance here, so it's you are going to make money if you sell here and take your profit here. But in reality, it doesn't happen. You just provide the bank with the sellers they need. If he is buying 1,000 lots here, he needs people who all together sell 1,000 lots. So he will create this image. You put your sale, you provide with enough sellers that he needs, and then he can buy and push the price up. And you do another service to the bank. You put your stop loss here. So when he pushes the price, when his buy orders open and he pushes the price up here, your stop loss is collected by these people and they make money. And with the money they make, they can buy more and push the price further up. They will play the same game here. This time maybe slightly different. We call this line a support and the resistance. So the price this time with the game they played here, they managed to push the price up here. So this resistance again is a support. So the normal trader, the poor retail trader will do what? He will see that this resistance is now a support. So he will want the prices to come back here. This is what he has in mind. The prices come back here, my stop loss is here, and now my target is here. Again, most probably, the price will come back here. This is what the retail trader has in mind. But what does the bank do is he will push the prices here, make it bounce a little bit, so people buy here, and their stop loss is here. Then he will come back here, collect your stop loss. Again, he makes money, and he will go here. Your stop loss does two things in the market. First, he provides the banks with money. And the second thing, let's say if you are buying here at this point and you're putting your stop loss here, your stop loss means what? Your stop loss means if the prices go below my stop loss, I want to sell. You are buying, but Your stop loss will close your deal as a buyer, and it means you, for example, you bought at 3,050 and you go out of the market with three at the price of 3,030. So at the price of 3,030, you sold what you had bought at this price. So again, you're a seller. You give them this $20 times millions of people who do this times the leverage, it becomes hundreds of millions of dollars probably, number one. And number two, he needs sellers, you are the seller, because your stop loss means you're selling at this price. So again, he finds enough sellers and he buys and he goes here. So to cut a long story short, technical analysis, the support and resistance, the Fibonacci, the moving average, to me, it's all bullshit. Excuse my language. You have to read the market from a bank's point of view. The banks will want to collect your stop losses. They push the prices here to collect these stop losses. And when they have reached their targets, they will again play games to make you think the price is at this level. They will want to sell, of course. So they will make it look like the price is going up, and you buy here and you put your stop loss here and it moves back. So again, at this point, they will look for enough stupid people to buy, so their sale deals open. This is what's happening in the markets. And this technical analysis that I said, like support and resistance and the Fibonacci and all these things, are the lessons they teach you in order to shape the collective behaviors of the retail traders in order to make them fuel in the market. Thank you very much for watching.